Hi everybody, welcome back to the channel. Today we're talking about the XDTE S&P 500 0 days to expiration covered call strategy ETF. So this right here is 0 days to expiration. This basically means that they are selling options with 0 days to expiration, as the name implies, which means they're about to expire, which means they have pretty much no value to them. But the goal is that they expire worthless, and they can keep on doing this. And what they're actually doing is paying out on a weekly basis. So when you buy this ETF, you're actually going to be getting dividends not on a monthly basis, but on a weekly basis, which I find pretty interesting. Now, there's been a few other ETFs which have done a weekly income strategy. This is one that, I haven't really done much research on. So we're going to kind of go over it together and look at this. So we have a covered call strategy ETF. If you look at the distribution rate, it says 18.13%. You look at the SEC 30-day yield, it says it's actually negative, which I find interesting. But this is called the Roundhill S&P 500 0 days to expiration covered call strategy ETF, ticker symbol XDTE. It's the first ETF to utilize 0 day to expiration or 0 day to expiration options on the S&P 500. XDTE seeks to provide overnight exposure to the S&P 500 and generate income each morning by selling out-of-the-money options that are 0 days to expiration on the index. It's an actively managed ETF. Now, if you look at the SPY, which you can take a look at, for example, just log into your broker and type in SPY options, and you'll see that they pretty much have expirations on every trading day. So what's today? Today's the December 4th. You would see one for, let's say, December 5th, December 6th. Today as well, you'd probably see one that's about to expire worthless if it's out of the money. So that kind of gives you an idea of how, if you look at each expiration on a daily basis, they're selling these basically each morning. They're trying to generate this income, and they're hoping basically that they expire worthless. So it's definitely an actively managed ETF. It seeks to pay out weekly distributions on sold option premiums. It seeks to generate income through a covered call strategy on the S&P 500, and it seeks to sell 0 days to expiration S&P 500 options, and then we're going to be basically looking at exploiting structural market mispricings. And so maybe they have more information on that in the prospectus in terms of exactly what they're talking about there and how they're actually trying to exploit structural market mispricings. I do find that language kind of interesting. But with that being said, we have the expense ratio here. Now, this is definitely going to be more on the expensive side. Anything less than 1% is going to be typical for ETFs. If you're paying 1 or 2% for an ETF, that's pretty expensive. If you're paying less than 0.5%, that's generally pretty reasonable. If you look at a Vanguard ETF, you can look at it from, let's say less than 10 basis points is what you're going to be paying. So 1/10 of 1%. This is almost 1 full percentage point. So definitely not the cheapest and definitely not the best expense ratio. But it can charge a little bit more, I think, because there's not many ETFs out there that are consistently focused on paying out these weekly income distributions. And so maybe that's what sets it apart. And so they feel like they can go ahead and, basically raise that expense ratio for investors in the fund. Assets under management, 252 million, shows the shares outstanding. Now with ETFs, you have this creation redemption mechanism where shares are being redeemed and vice versa based upon the demand for the shares. But if you look at here, it says active management style. It was launched in March of 2024, so this year actually. And if we look at since inception, when this was launched in March, it's pretty much done nothing in terms of the share price, pretty much flat. It is up about, let's say, all time 3.32%. If you look at the last year, I guess, or since just depending on the time frame, year to date 2.27, the last 6 months 3.41, 4.17 the last month, the last 5 days. But really, this has only been around since March, so it is kind of trending up a little bit. But compared to the market over this time frame, and this is going to be one of the major trade-offs. If you look at the SPY, you can just see, for example, since even March or is at 514, now we're at 607. So there's been a lot of missed opportunity cost in terms of, rather if you would have just bought the S&P 500, or if you buy this ETF, you're basically betting on those income distributions, which weekly income is a cool idea. So if you look at the actual distributions, you can see here all these different dividends being paid out. And I have to say, if you look at how consistent these dividends are, they have been quite consistent. Now, this one was only 2 cents, right? So you have some months that you're paying out like 20, 30 cents per share, or some weeks, not months, some weeks, you're paying out, 13 cents. Here's an 11-cent one. Here's a 21-cent dividend, another 24-cent dividend, another 20-cent dividend, 23 cents. But every single week you're getting basically, I would say, a pretty good payout. Now, if you figure if they're going to do it, let's say 15 or 20 cents, even just to be conservative, if they're paying out 15 cents on a weekly basis times 52 weeks, that's $7.80 that they're paying out per year. If they're paying out on average 15 cents per week, if you're looking at $7.80 divided by the current price of the ETF, which is 53.65, then you would actually be talking a distribution rate of 14%. Now, I've seen these covered call ETFs paying anywhere from 7 to 10 to 12% or more. So that's not entirely unreasonable, to be paying 14%. And if you're figuring even more than that, let's say 20 cents on average, which is kind of what we were noticing there in that pattern. Some months were even 30 or 40 cents it was paying out. And then you take a $53 share price, let's say. Now you're talking closer to 20% in terms of the total distribution and how much you're going to be getting paid out. And once again, just looking at all these different dividends that it's been paying out on a weekly basis, July 18th, 2024 was the X date on that one, October 24th on that one, November 21st. And you can also come on over to NASDAQ.com, type in NASDAQ.com or NASDAQ, and then type in the ticker symbol, which would be XDTE. I keep on forgetting XDTE. This is a brand new one that I just discovered as well, guys. So I'm kind of going over it like in the last video I did with the other one. I kind of like doing this, just going over it with you because I'm learning something brand new here as well. So you see the most recent payments every single week like clockwork. And really just looking at this from multiple dividends at once, you can see where they're paying and, 33 cents a share in a single week, 38 cents, 41 cents. The lowest we've seen here, it looks like, quite honestly, it looks like it's pretty consistent in terms of what they're paying out. Most months you're getting roughly 20 cents. You had a 15-cent month there, 18 cents. But that would kind of put you on track to, let's say, do 15 or 20% in terms of those distributions. And so if weekly income is your thing, then maybe this is something to consider. Always consider your own risk tolerance, your own investing goals and everything. But I did find this ETF interesting. Keep in mind, it's going to be a little bit more expensive in terms of the expense ratio, and that is one thing to consider. But if you look at the holdings here, you can see what they're doing, and it kind of has the actual options contracts. It has the call option contracts and everything that it has on this portfolio here. So you have all of that on roundhillinvestments.com. You come on over here, learn about the ETF, learn about the different holdings, learn about how it's, basically trading this. You can look at the most recent distributions on this website as well. You can look at all the different stuff. But there's a lot to consider here. If you think about an ETF like this is definitely not normal. There's not a lot of ETFs, let's say, that pay out on a weekly basis. But since inception, the ETF has held up okay. The share price has. Now, as far as those distributions, they've also held up pretty good since inception as well. So consistently getting 20 cents every single week does not sound like a bad gig, right? And so if you do the math, like I said, on the total yield, you can figure, let's say, 15, 20% per year in terms of that distribution rate, which I think the website, Roundhill, was just saying it was around, 18% for that distribution yield. So let me know what you guys think in the comments down below. Would you be interested in buying an ETF like this for weekly income instead of monthly or quarterly income like you typically get from, dividend stocks or ETFs? So let me know what you think in the comments down below. With that being said, we will see you guys in the next one. God bless you all. Take care. And thanks so much for tuning in.